What's up, everybody? It's Jonathan Rose from Active Day Trader. Today, Fed Day. Thought it'd be a good day to talk about the yield curve. So in front of you, I'm at the CME Group's website. I'm going to leave a link to this exact page in the description so you can go here, play around with it. I want to look at the entire yield curve. And so that's what we have right here, and this is the current yield curve. And it goes from the 2-year, 5-year, 10-year, Ultra 10, 30, and Ultra 30 year. Now, each of these contracts, you can trade futures. These are the liquid future contracts that are traded from the Chicago Mercantile Exchange. The 2-year is going to be the ZT, 5-year is the ZF, 10-year is ZN, the Ultra 10-year is going to be the TN, the 30-year is the ZB, and the Ultra is going to be the UB. Now, we trade quite a bit of bond futures because right now it's a really excellent trade because the Fed's moving. When the Fed moves, there's uncertainty, which drastically will affect the shape of the yield curve. And you can see right now it's kind of kinky, right? It's not like a smooth curve. The cool thing about this tool is you can compare the yield curve to 1 year ago. Apply. And here's the difference in the shape. Right now, currently, it's going to move a little bit because Fed. This front end is going to come up. This back end, I assume, will come up. If it doesn't come up, we're going to have a flattening. Now, you can see right now, the yield curve is flat relative to where it was 1 year ago. So if we look back here, which still overall historically is considered flat 1 year ago, now it's almost like flat as a pancake. Now the difference between 2-year rates and 30-year rates is like a half a basis point. This behavior over the last year is called a flattening. A very big flattener has gone on, and you can see that because the 30-year hasn't really moved very much, but yet the front end has come all the way up. Now historically, I'm pretty sure 100% of the time, the yield curve has actually gone inverted. It's been the predecessor of a recession. So if this 2-year and 5-year get above the 30-year and the back end of the curve, that's really scary stuff. And what's crazy is the overall market's still ripping through its highs, but yet the yield curve flattening to recessionary levels. This tool as well, let's compare it to 6 months. The 6 months is going to be the orange. The green is going to be 1 year ago, and the blue is present day. So again, let's talk about what happened. 1 year ago, steep, started flattening, and you can see 30-year rates actually went lower while the front end was going higher. So if the front end goes higher, like it's doing here, the back end goes lower, that's called a flattener. 6 months to current, it really hasn't moved. It really hasn't steepened very much. But what happened is rates have gone higher across the board because the Fed's moving the front end. So naturally, the back end has to go higher. And if the back end doesn't go higher, we are going to have an inverted yield curve where the front end is going to be higher than the back end. Why we like in Active Day Trader and my coaching students, why we like selling the back end of the yield curve, selling future contracts, whether it be the ZB or the UB, is because we know the Fed is moving. The back end has to go up unless it's going to go inverted. It's not to say it's not going to go inverted. It can go inverted. I just think it's very unlikely. What I think is going to happen is the Fed will continue raising shorter term rates and the back end will stay flat or somewhat flat. But the back end, it's got to get way up here or else, again, it's going to go inverted. So there you have it. Play around with this tool. Really, really cool, really interesting. But the reason I like it so much is because I think it clearly allows traders to learn the difference between a flattening trade and a steepening trade. Hope this video helped. If you have any questions, just leave it in the comments. Happy to answer. Jonathan, Active Day Trader.